We'll pose all these questions with Shyam Srinivasan. He's joining us. But before we go across and talk about the markets per se, first we'll talk about their earnings. Remember, their profits were down 44% on account of very sharp increase in provisions by 290% on a year-on-year basis. Though the good part is asset quality has improved a bit. Federal Bank is down 1%. Hi, sir. Thanks so much for joining us. First, could you tell us what necessitated the need for such high provisions? They are up 150% on a quarter-on-quarter basis and up 290% on a year-on-year basis.
Yeah, this is largely on account of one account which was provisioned partially. We provided 100% for it, and a couple of restructured accounts that slipped, CDR accounts that slipped. So we've provided quite prudently for that, and we've maintained our overall coverage ratio at 70. So we didn't want to dip into our coverage to flatter the profits. So we focused on the operating profit, and the balance sheet is getting a lot more cleaner. Operating profit grew quite handsomely, 16% on a sequential basis. Partly the treasury gains were there, but even more on an operating level, the performance is more encouraging.
Okay. Shyam, actually your total gross NPLs are down 5% on the quarter, but as a percentage of the total book, they are up from 3.44 to 3.51. So looks like your asset book has shrunk. You're lending less as of June 30th as compared to March 31. That's significant. Do you think this contraction will continue for some time?
See, there are a couple of things. One was on the large corporate side, almost 2,000 crores of repayments from short-term loans, and we didn't seek to renew them. And we consciously de-grew gold partially, only because we wanted to make sure that we don't run into the wrong end of the pricing structure. But that, I think, having been addressed, we see gold growing back. Large corporate advances, I'll keep my fingers crossed, because I'm not yet seeing much momentum. Retail SME growth is robust, but large corporate, yes, it's something that's on the watch. But we de-grew almost 2,500 crores in Q1, so that's why the denominator effect is playing out on the gross NPA.
That's what I was asking. So is this degrowth or contraction of your balance sheet to continue for the current quarter as well?
Q2 may not be dramatically different, but for the full year it could be a lot better. Q2 depends on how the drawdowns happen on all the sanctions we've made on the large corporate, but I don't see a magnificent rise in the large corporate advances. Retail and SME will bounce quite well. SME grew handsomely in Q1, that will continue, but overall numbers may not be dramatically more, because large corporate tickets really swing the denominator, but that we will be more watchful of.
I notice a lot of caution in your voice when you're talking about corporates and about this gold loan bit as well. In fact, other banks which normally don't report higher NPLs quarter on quarter, like HDFC Bank, also reported higher NPLs. So did DCB. So did I guess even IndusInd Bank to some extent. What is your sense? Is asset quality going to get worse before it gets better?
Sorry, the line is intermittent. I'm not able to pick
Do you
up what you're
expect
asking.
asset quality to get worse before it gets better?
It will be a mixed bag. We've seen good progress on retail SME. That has been effort elastic. In the large corporates, as you've seen, it's been very choppy. A couple of large restructured accounts have slipped. And I would think the Q2 would be better for us, at least for Federal, better for us than it was in Q1, because we've been addressing some of these for many quarters now. But the market remains quite fluid. I am not yet convinced that the bigger corporates who are over-leveraged have come out of the stress they are in. There are multiple factors playing out. So it's a period of extreme watch. I don't think we can predict with great confidence that how the year will play out.
Mr. Srinivasan, could you tell us a little more about the relapse of the two restructured assets this quarter? Is that a trend?
Sorry, what?
We understand that there was a relapse of two accounts, which got restructured this time. There was a relapse. So could you tell us a little more on that? And is that a trend that we could, watch for going forward or will continue?
Can't quite say whether that's a trend, but these two were, even at the time of being restructured, about 6 odd months back, it's a large consortium-led restructuring. One is a large pharma company in the north, and they were not meeting their standards, and therefore they were sort of dissolved from the restructuring, and consequently we had to take. But I don't think it's a trend. I mean, we don't see many more such restructured accounts which are as shaky as these were. We were conscious of these two. We didn't want to prolong the problem, which is why we absorbed them as loss assets and moved on. That may not be a trend. I don't see that because at least in our book, the bigger restructuring is the electricity boards, which are for now performing to the original standard. They may request a change in the terms, but I don't see them slipping.
Okay. You spoke about gold. You said abundant caution has made you kind of contract that book. Can you give us some color on whether you saw defaults in gold and even for the system actually, if you can?
We didn't see defaults, but yes, there were calls for payment and customers had to either bring in more or to liquidate. I think the net impact in slippages term was under 4 crores, if I remember the right number, on a 6,000 crore plus book. So we didn't see any defaults, but the system is, I think, a lot more conscious and cautious about growth in gold. Everybody is looking for price stability, because the volatility in price causes the stress. If price stability, which I am seeing now, because more or less it's been in the 27,000 rupees per gram kind of rate, then we are in the zone to get the growth back. But for now, there has been stress, and particularly the NBFCs may have seen some stress.
You spoke about that one account which resulted, for which you had to, do 100% provisions and a few CDR accounts as well. Do you see high provisions extending into the next quarter as well?
I won't venture into giving a very profound provision forecast, but it will definitely be a lot better than what we saw in Q1, because this was a combined effect of two large restructured account slipping and an account that required 100% provisioning, and at the same time we held on to our overall coverage ratio. So the mix was quite impactful. That may not repeat itself.
And any guidance?
Yeah, finally, actually, Shyam, your loan growth was pretty weak this quarter, 8.5%. And you're already saying that this quarter and the previous, you are probably in contracting mode. So for the year, what will you grow in terms of your total book? As well, will you have to raise money at all on the capital front?
My guidance is more around how we see in the areas that are more predictable. Retail and SME, we are tracking and trending 20% plus, and with that we will continue. Large corporate, I'll have to watch for at least a couple of quarters to be a lot more confident that the growth is predictable and sustainable.
I meant at the total, total book level, Shyam.
Yeah, the total book is why I'm disaggregating and giving it to you, because at the beginning of the year we had guided for a 20% growth, almost equally weighted in all the businesses. Large corporate, we are being a little more circumspect, only because the market, drawdowns on big sanctions that are quality sanctions are not happening. It may be true for the industry, so I will be a little more watchful of that before I extend a confident forecast. But the growth in retail SME are predictable and sustainable.
Okay. Well, thanks a lot, Shyam, for joining us with all those details.